Welcome to The Explainer. Today we're tackling a really crucial provision that every business owner, accountant, and tax professional needs to understand inside and out. Section 74 of the new Income Tax Act 2025. It's all about how we handle capital gains on depreciable assets.
So let's start with a situation you've probably seen 100 times. A company sells an old machine, and they actually get a great price for it, way more than its current value on the books. So that profit, is it just straightforward business income? Well, you might think so, but the tax law has a very specific, and I'd say a pretty clever way of looking at it. Let's find out what's really going on.
So here's how we're going to break it all down today. We'll start with the puzzle itself, then decode the law behind it, see a calculation in action, and wrap up with some practical tips on compliance and the pitfalls to avoid.
Right, let's get straight to the heart of it. The real puzzle here is figuring out that specific moment when the profit you make from selling a business asset, something you've been depreciating for years, suddenly stops being treated as normal business income and transforms into a capital gain.
And the key that unlocks this whole puzzle, as you might have guessed, is found in one specific place, Section 74. This is the section that gives us the exact rulebook, the precise mechanism for calculating and classifying these gains. It's tailor-made for this exact scenario.
Okay, so let's pop the hood and take a closer look at the legal blueprint of Section 74. To really get it, we need to be crystal clear on a couple of foundational terms first.
First up, and this is absolutely fundamental, is the concept of a block of assets. Think of it like this. Instead of tracking every single chair, computer, or machine separately for tax depreciation, the law says, let's group all similar items, the ones with the same depreciation rate, into one big basket. This is so important because we calculate depreciation on the value of the entire basket, not on each individual item.
And that, of course, brings us to the value of that basket, the written down value, or WDV. As Section 41 lays it out, the WDV is simply the value of the entire block after you've subtracted all the depreciation you've claimed in past years. It's your tax purpose opening balance for the year.
Now here we go. This is the absolute soul of Section 74. The law uses what's called a deeming fiction. It says that if certain conditions are met, the profit is deemed to be a short-term capital gain. And listen, it does not matter if you own that asset for 2 months or 20 years. The law just says, nope, in this case, it's short-term. That automatic classification is the whole point.
Now, for any of you seasoned pros watching, this whole idea might feel, well, pretty familiar, and you'd be absolutely right. Section 74 isn't some brand new concept pulled out of thin air. It's the direct successor to Section 50 of the old 1961 Act. The core logic, the mechanism, it's all been carried forward, ensuring that we have consistency in how we treat these games. All right, enough of the legal jargon. Theory is great, but let's make this real. We're going to walk through a practical, number-crunching example to see exactly how Section 74 plays out in the real world. Okay, so let's imagine a company. At the start of the tax year, the opening WDV of their plant and machinery block, that basket we talked about, is 10 lakh rupees. During the year, they buy some new equipment for 2 lakh. Then, they sell off an old machine, and they get a whopping 15 lakh for it. And to make that sale happen, they had to spend 50,000 rupees. So, how do we process this? It's pretty straightforward. First, let's figure out the total value of our asset block before we account for the sale. That's the opening 10 lakh plus the new 2 lakh purchase. So the block value is 12 lakh rupees. Next, what did they actually pocket from the sale? Well, they got 15 lakh, but spent 50,000, so the net sale proceeds are 14 lakh 50,000. Now we compare the two, and bingo! The money they got from selling one asset, 14.5 lakh, is more than the value of the entire block, which was 12 lakh. That is the exact trigger for Section 74.
And here's the final result. You take the net sale proceeds of 14 lakh 50,000, subtract the block value of 12 lakh, and you're left with a 2 lakh 50,000 rupee short-term capital gain. And just as important, what's the value of that block of assets for the next year? It's zero. Nil. There's nothing left to depreciate.
Okay, we get the law and we've walked through the math, but how do you actually apply this in your daily work? And more importantly, how do you avoid tripping up? Let's cover that right now. Honestly, staying compliant here really just comes down to good old-fashioned discipline and meticulous records. You absolutely need a detailed fixed asset register, you have to get the assets into the right blocks, your WDV calculation at the start of the year needs to be spot on, and of course, you've got to disclose the gain correctly in your ITR and keep all the paperwork to back it all up.
And on the flip side, here's some of the classic traps people fall into. The biggest one by far is misclassifying the gain.
calling it business income or even worse, long-term capital gain. That's a direct violation of Section 74. Other common slip-ups include forgetting to deduct sale expenses or trying to put an asset in the wrong block just to get a higher depreciation rate. These are exactly the kind of mistakes that attract unwanted attention.
All right, we have covered a lot of ground. So let's just take a moment and boil it all down to the absolute essential takeaways you need to remember about Section 74.
So let's lock these in. 1. Section 74 is only for depreciable assets that are part of a block. 2. The rule kicks in when the net sale proceeds from an asset wipe out the value of the entire block and then some. 3. And this is the big one, the resulting gain is always deemed to be a short-term capital gain. No exceptions. 4. This isn't new. It's a continuation of the old Section 50. And 5. After you book this gain, the WDV of that block for the future is wiped clean to zero.
And this leaves us with a final, more strategic thought. The section isn't just a compliance headache, right? If you understand these tax implications, how might that influence a company's actual business decisions? Could it change your thinking on when to replace old assets or how you budget for major capital expenses? It's a really interesting intersection of tax law and corporate strategy.
And that's our look at Section 74. We really hope this explainer helped make a tricky topic just a little bit clearer for you. If it did, we'd really appreciate a like and a subscribe. And of course, please share this with any colleagues or friends who might find it useful.
And just a quick, important reminder, this video is purely for educational purposes. Tax laws are complex, they change, and this is not professional advice. So please, always consult with your professional advisor before taking any action based on what you've seen here. Thanks for watching.